I want my money to work for me is something that I hear quite often from women entrepreneurs who are at a point in their business where they're generating enough profits and enough cash flow that they're able to save money. And they're ready to invest and build wealth, but they don't quite know what type of investing they should do, where they should invest their money, and what kind of return they can expect for their money. Also, we know that investing involves risk and you can lose all of your money. So how do you know how much you're risking when you invest in a certain type of a security? So in this video, I'll break down 5 of the most common types of investments that I see in the portfolios of wealthy individuals. And I will share from my perspective what is a security, why it's great, how you make money, what kind of return you can expect, and finally, what kind of a risk you're assuming by investing in this type of a security. We will be talking about stocks, real estate, private equity, private debt, and venture capital. You'll notice that I'm not speaking today about savings accounts or cash investments, because while saving is great, it's not really investing. And there is ways to make money on your savings, but it's not really going to get you to wealth. In another video, we'll take a closer look at cash, the best uses of cash, and what you should do with your cash to build your emergency fund or whatever purpose that the cash can serve. But that's a conversation for another day. So let's start with stocks. What is a stock? Basically, when you invest in stocks, and you're probably familiar with it, you're taking ownership in a company, whether in the US or international company, and you're buying the shares of the stock and becoming a shareholder, part owner of this company. And when the company's profits rise, the stock price goes up and you make money. So investing in stocks is probably the most straightforward way to invest, and you can invest in the individual company, individual stock, or a basket, a list of stocks in the mutual fund. Basically, in the mutual fund, you don't have to worry whether you should buy Facebook or Amazon or Google and how much of each you will buy. You're hiring professional managers who spend every day of their career figuring out these questions for you. What is great about stocks, they're very familiar, they're very stable. Most companies in the US and internationally go up in price over time if they make good decisions and increase their profits. US market is very liquid, which means that your money will not get stuck somewhere, and if the market goes down, you're able to get out of the stock pretty easily and not worry about losing your money, not being able to liquidate your investment. How do you make money with stocks? There are 2 ways that you make money in stocks. Primarily, there are the dividends that the company pays from its profits. Basically, when the company makes money from its customers selling its products and services, they give back some of those profits to their shareholders every month or every quarter, a certain amount per share of dividends, and that money is yours to keep. So dividends is a way to make money with stocks, and the second way to make money with stocks is price appreciation. So those 2 things together is what makes up the return of a stock. How much money can you make from a stock? What is the rate of return, as we speak, that you can make off of an investment in stock? Here's how I think about it. In a given year, it could be all over the place. Some stocks can go up in prices, some stocks go down in prices, and the amount that they go up and down can be very, very big, and there is a big range of possibilities. But if you invest in a number of stocks and you invest in them for the long term, overall, I would say you can expect your portfolio to grow about 10 to 12% on an annualized basis, as we say, over time. Meaning if you invest $100,000 in stock and you keep it for 5, 10, 20 years, and you look at it at the end of your investing horizon, if you look at the change in your portfolio over time, it will come to about 10% per year. That's investing in stock. Now, the second really good way to invest and make more money and make your money work for you harder is real estate. Many people, I feel like especially women, are fond of investing in real estate because A, it's a great way to buy an asset and have it and see it grow in value. But also, real estate is very tangible. You can touch it, you can see it, you can walk through it, you can paint it, you can decorate it. So it's a great asset for you to have. And also, investing in real estate generates immediate cash flow and rental income from this asset that you will buy. So real estate is a great way to invest and make money. And real estate also is very versatile. There are literally a dozen ways you can invest in real estate. We will talk about 3 or 4 of the most common ones. The most straightforward way to invest in real estate is buy a rental property. You buy either a house or an apartment. Maybe you fix it up and then you turn around and rent it out. You receive the monthly rent. The second type that I actually prefer is something that's called a multifamily syndication, where you don't buy a property, but you buy into a fund, into a structure that is created by a management company. And what they do is that they actually buy not individual houses, but they buy big buildings, big apartment complexes where people rent the apartments and the management company manages the investment, improves it, makes the repairs, takes care of the renters. And every month when those renters pay their rent, syndication collects the rent and it distributes a part of the rent to you as a return on your investment. So these syndications don't last forever, and in addition to the rent that you receive, you can also participate in the appreciation of the property. So when the house price goes up, even though with time, because most asset prices do go up in time, or because the management did such a great job improving the property, when they sell the property, you will receive your profits. So for busy business owners, for busy women who are juggling their life and career and so many things, I find that multifamily real estate investing or syndication investing is optimal, because similar to investing in the mutual fund where there's a professional management, you just put your money in and you find a good company that you trust and you get the returns. And again, so investing in real estate does involve a lot of risk, which has to do with the economy, whether those renters are going to go or not. If you invest in a property, a lot of times where the investors go wrong is actually not understanding the cash flow and exactly how much and how expensive it is actually to maintain a property. So you may be in a situation where you invest a lot of money and you lose it because your expenses are not covering your costs. And what I've also seen a lot with real estate investors, if you're not really careful, you may not even know that you're losing money because the cash flow keeps coming, and if you're not really good at looking at your income and loss statement, you may be deluding yourself that you're actually making money with real estate. 2 more ways to invest in real estate is commercial real estate instead of residential. There are funds that invest in real estate, and also there is what we call the REITs, real estate investment trusts, that are similar to actually investing in the stock market because they do trade on the stock market, and that's the most passive way of taking advantage of real estate. REITs are extremely interesting instruments. They're also complex, and there are different types of REITs depending on your goals and how they make money, how they're created, what their regulations and what are the rules around the distribution and what they owe investors. That's a fantastic video that I have recorded, and you can find it in the links in the investing playlist of this channel. So far we have covered real estate and we have covered stocks. And now what I want to go towards is the types of investing that are called private investing. So one thing that I want to mention really briefly is there are certain types of investments for which you need to qualify, and you need to be an accredited investor. If you're not familiar with what an accredited investor is, it's basically a way the government has come up with to make sure that when you invest your money, you're not losing your shirt and you're not exposing yourself to undue risk. So basically you need to have enough assets or enough income so that if you lose your entire investment, you're not struggling that you cannot pay your mortgage and you cannot pay your expenses. Again, being an accredited investor and what it is, how you can find out whether you're one or not, is a separate video that I have recorded, and it will be in the investing playlist of this channel. But let's look at private investing. So first we're going to talk about private equity and private debt. So these are the 2 ways that you can get money to a private company that is not traded on the stock market and make your return. So let's start with debt because it's probably a little more straightforward. Basically, with private debt, you take your money and you lend it to a company that needs it for its operations or to grow. When you invest in private debt, what you get is interest, whether quarterly, semi-annually, or annually. And then there is a certain amount of money, the principal that goes goes to a company for a certain amount of time. Say you invest in private debt for 5 years. So for the period of 5 years, you'll make the interest. And at the end of 5 years, you'll also get your money back. So that's debt. And what that means, you're a creditor of a company and not an owner. Meaning if the company does great and it grows exponentially, you still get your interest and your principal back. So you don't participate in those profits. But if the company does poorly, you're also not taking on the risk. As a creditor, you have a preference. If something goes wrong and the company needs to be liquidated, you get your money before the shareholders do. In private debt, you actually have to look around for specific companies, specific vehicles, specific managers who can take your money and invest in private companies. So if you look at the balance sheet, and that's actually not the topic of conversation, but private debt belongs on the liabilities side of a company's balance sheet, meaning that the creditors of the company end up in the private debt section. On the opposite, private equity is very similar to the way you invest in stocks, but instead of investing in a public company, you're investing in a private company with all the pros and cons associated with it, with the exception that these companies are a little less regulated. You cannot trade them on the stock market and they're not liquid. So basically, when you invest in a private equity, you are locking in your money for quite some time. It could be 5 years, it could be 10 years. And the way you make money mostly is this private equity, private company needs to have an exit, which means the company would either be sold and the new investors will give you money that will be the return on your investment, or this company will actually go public, which means that it will start trading on the stock market and you can get either the shares or you can get out of this investment completely. So that's the private equity and private debt. And the last type of investing that I want to talk about that belongs in your portfolio is venture capital. So how is venture capital different from private equity? It is similar, but with venture capital, the companies are usually way newer. They're not at a mature stage in their companies. With venture investing, you start with a really small startup and you become an angel investor. It could be your family, somebody you know personally who's starting a venture, starting a company, you believe in them, and they come to you and they say, hey, I have this great idea and I need money so that I can grow. And you believe in them, you do your due diligence, meaning that you do a little bit of digging and research and you believe in the potential and you invest as an angel investor. The next stage of it, you put your money in a venture fund, and the venture fund invests on your behalf in an early stage startup that's a little beyond the angel capital, meaning they have proven themselves a little more and they are making money and they just need the growth capital. So, and you can invest in multiple rounds, round A, B, C, and the higher the rounds, the higher the stakes, but the higher the probability that the company will be successful. And what are the risks with all private company investing? First of all, just with any investments, these companies can go belly up, they can go out of business and you can lose all of your money. And there isn't much recourse to it because it's your money, it's just kind of a private deal between you and this company. And the timing of it could be really good or really bad. And last but not least, again, you're locking up your money for a while. So you need to be aware that if you put that money, that part of your portfolio is not as liquid as the mutual funds that you trade in the public markets. So we looked at 5 types of investing that can generate returns. And yes, I did not mention with the private equity, the returns typically are higher than the stock market if you do it right. So you could gain to way more than 10% over time, but that's much harder to identify these winners. So again, we looked at stocks, we looked at real estate, we looked at private equity, private debt, and venture capital. These investments belong in a well-rounded portfolio of a successful woman entrepreneur. You probably have noticed that I mentioned the word portfolio a few times. And if you're wondering what a portfolio is and how you should go about creating one and why you need one in the first place, that's an excellent question. And it's super important for you to have a portfolio view, a portfolio perspective on your investing. So once you're ready, click on this video here that will talk about portfolios. Enjoy the video and happy watching.